Hello dear students, let us understand in this video about a very important financial statement analysis technique that is called as ratio analysis. Yes, it is ratio analysis. Why did I say that this method is very important or a very important financial analysis technique is because ratio analysis is world's most widely used technique to analyze any financial statement. You go any country around the world and you would find companies and analysts doing the ratio analysis. So this becomes a very important part in the life of a finance manager. When we come to ratio analysis, let us try and understand that who all are the people who are interested in analyzing the company's financial statement. Companies' financial statements are analyzed by various stakeholders. These stakeholders include internal stakeholders as well as external stakeholders. When we say internal stakeholders, it includes the finance managers, it includes the owners of the company, it sometimes even includes the employees of the company. Whereas when we go to the external stakeholders, it includes the investors, it includes the money lenders, it could be banks who are giving loans to the company, it includes the shareholders who are investors who are going to purchase or who have already purchased the shares of the company. It includes government because for taxation and all other purposes, and also to ensure the insolvency of the company or to predict the insolvency of the company, governments may use financial statement analysis, chartered accountants, taxpayers, financial analysts, fund managers of various mutual fund companies or asset management companies, so as whether to invest in a particular company or not. All that is decided by analyzing the financial statements of any company. And as I said, mostly used worldwide technique is your ratio analysis. That is why it is very essential for us to understand this technique thoroughly, and we ourselves should also be able to analyze our own company, whether we are working for that company or whether we own that company. In either of the cases, we should be in a position to analyze the financial statements. Now let us understand what exactly this ratio analysis is. Ratio analysis can be defined as, or rather the ratio first can be defined as the arithmetical relationship between two figures. You take any two figures and when you divide one by the other, whatever answer you get is called as the ratio, which we have already seen in our schools. Yes, since absolute figures do not convey absolute meaning, unless compared with other figures. Say for example, let us have an example. We have a company which is having annual net profit for the year ending 31st March 2020. The annual net profit was say 300 crores. Is the figure good? Yes, looking at this figure, we can say that this is good profit. But what if I tell you that the previous year's net profit was 700 crores and this year it is 300 crores. So whenever you compare a figure with some other figure, it becomes relative and only then you can decide whether it is really good or not. Yes, that is what the key lies in. See, and that is the reason what we do is we use ratios. Or take another example. There is a company making 100 crores profit from 500 crore rupees assets. And there is another company also making 100 crore profit but from 1000 crore rupees of assets. Now which company is better? Obviously the first one, because it is making more profit out of lesser assets. This is the beauty of ratio analysis, and that is why what we do is in accounting ratios, what we do is it is nothing but we try and find out an interrelationship between the figures from financial statements. Now just the example that we have taken, one figure, that is the net profit, comes from your profit and loss account, from the income statement, and the other figure, that is the fixed assets or total assets, it comes from your balance sheet. So we should remember one thing, that when we say ratio analysis, it is not confined only to a single type of financial statement. It could be crisscross. You can have figures from different statements. It could include your trading account, it could be profit and loss account, or your balance sheet. And figures from different statements can be clubbed together and can be divided with each other, and a ratio can be formed which would have some meaning to it. Yes, that is your ratio analysis. Now, for ease of understanding, the ratios have been classified broadly into 5 types. If you keep on calculating, or if you just keep on listing down the ratios, there could be n number of ratios. You can even go and make a list of more than 100 ratios. But for ease of understanding and based on the utility, the ratios are classified into these 5 major groups. Firstly, you have liquidity ratios, profitability ratios, turnover ratios, the leverage ratios, and market related ratios. When we say liquidity ratios are mainly concerned with the liquidity of the organization. Whether a company is able to fulfill or to satisfy its short-term needs, that is it able to fulfill the current liabilities by using its existing current assets? To find out this is called as liquidity assessment, and for doing liquidity assessment, liquidity ratios are used. Next is profitability ratios. Profitability ratios are the ratios which can assess the profitability or the returns that the company is generating based on its resources. In this, you can compare the gross profit to sales, net profit to sales, sales to total assets, sales to fixed assets, sales to capital employed, or in any other form. So ultimately it is assessing the profitability of the organization. The third is turnover ratios. Turnover ratios are nothing but efficiency ratios. These ratios tell us that how efficiently the assets or the resources of the company are used. How efficiently, that means in how can you produce more output from lesser cost. Next is leverage ratios, also called as capital ratios. These ratios are related with the capital structure of the company. Various types of capitals, may it be borrowed funds, owned funds, or any other source of fund, and how it is used by the company. And the last part is market related ratios, which are mainly related with the market prices or the performance of the company's equity shares in the capital market. So these are the ratios. Now let us go and see each ratio one by one. Why we are doing this? Because once we are thorough with the type of ratios and the way of assessment and the way of evaluating the ratio, we can easily analyze the financial statement of any company. So let us go ahead and see each type of ratio. The first is under liquidity ratios. What we have, the first ratio is called as your current ratio. The formula is very simple. For current ratio, it is nothing but current assets upon current liabilities. It is current assets upon current liabilities. What are current assets? Current assets are the assets which are to be converted or which would get converted into cash within a period of maximum 1 year. And current liabilities are the liabilities which are to be paid up within the given financial year. That means these are the assets for the given year and these are the liabilities for the given year. What does this ratio assesses? This ratio tries to identify the ability of the current assets to fulfill its current liabilities, whether a company is able to fulfill its current liabilities by using its current assets. The ideal ratio is 2:1. So it means that your current assets should be twice that of the current liabilities, so that the company can easily and comfortably fulfill the current liabilities by using the current assets. That's your first liquidity ratio. Next, under liquidity ratio itself, we have another ratio called as quick ratio or acid test ratio. Quick ratio or acid test ratio. In this, what is done is, when we say current assets, it is considering only liquid current assets. So what is done is, see the denominator, that is current liabilities, it remains same, but from current assets, your inventories and prepaid expenses are deducted. Now why are they deducted? Inventories is nothing but which is available with you in material form, in hard form. You are not sure that whether the inventories will surely be converted into cash in this year, or would the output be transported, shifted or transferred to the next year as the closing balance for this year, which is not directly and immediately getting converted into cash. So inventories are deducted, and prepaid expenses which are already paid, now you are not going to get any cash out of it, which is already paid, that is okay. But even if it is paid, are you going to get any revenue from this, the prepaid expenses? The answer is no, and that is why inventories and prepaid expenses are deducted from current assets. So when these two items are deducted from the current assets, it forms liquid assets, and liquid assets upon current liabilities gives you quick ratio or acid test ratio. The ideal ratio for this is 1:1. The ideal ratio is 1:1. That means your liquid assets and current liabilities should at least be equal to each other. If you have the ratio more than 1, that's good, but at least it should have 1:1 ratio. The third type of liquid ratio is even going further. It includes, that's called a super quick ratio or cash ratio or absolute liquid ratio. There are three names given: absolute liquid ratio, cash ratio, or super quick ratio. What does it say is that previously we were considering current assets. In the next, we have deducted inventory and your prepaid expenses. Now here we are considering absolute liquid assets. Absolute liquid assets, which means which can be easily converted, either it is cash or near cash items. When I say cash, it's your hard cash. It could be cash in hand or cash in bank, and marketable securities includes all your checks or any financial instruments which can be converted into cash within next 2 to 3 days. This numerator is called as your absolute liquid assets, and denominator is the current liabilities. That means to fulfill these liabilities, how much ready cash or ready liquid assets do you have? Yes, that is the assessment that is given to you as by the super quick ratio or cash ratio or absolute liquid ratio. So these are the liquidity ratios. There are many. You can even design your own liquidity ratios, but these three are sufficient for us. The next type of ratios is your profitability ratios. Under profitability ratios, as I said, we are assessing the profitability of an organization. Under profitability ratio, the first ratio is your gross profit ratio. The first ratio is gross profit ratio. What does it mean? The formula is simple. It is the gross profit of the organization divided by net sales multiplied by 100. The formula is simple. Gross profit, you just have to pick up from your trading and P&L. Use that figure divided by the net sales. What do you mean by net sales, by the way? Net sales are nothing but your total sales less returns. If sales returns have been received, any sales have been returned to the company, that has to be deducted from the total sales figure, and we get net sales. So it is nothing but gross profit upon net sales multiplied by 100. Net profit ratio is nothing but the net profit after tax. Net profit is profit after tax upon net sales. So profit after tax is the last figure after deducting even the taxes, interest, everything is deducted. What you get is the profit after tax, that is divided by the net sales and into 100. See, whenever you have this into 100, it means that the answer is going to be in percentage form. So here you will get gross profit percentage, here you will get net profit percentage. Next is operating profit ratio. Now what exactly this operating profit is? See students, many times what happens is, even if a company is into some X business, but due to some, say for example, Say for example, you are in an automobile company and the company is into selling cars. They are manufacturing cars and they are selling those cars. But while doing so, a lot of scrap as well is collected. For last couple of years, the scrap has been dumped in their dumping ground. Now suddenly, in the last month, your company has decided to sell off those scrap, and then that scrap was sold for a pretty good amount. Now that was an income. Yes, that was again an income. It is a revenue which is coming in. But is that money coming in your organization because of your core operations, that is selling automobiles? The answer is no. It was the money which has resulted from selling scrap. So that becomes non-operating income. So what is done is, in case of operating profit, we are trying to identify that how much exactly is our profit from actual operations, from our core operations. To assess that, what we use is the operating profit ratio. And for using that operating profit ratio, the formula is your net profit plus non-operating expenses. Why is this done? Because there could be some non-operating expenses which were deducted to calculate the net profit, but which were not related to your operations. So those expenses which were deducted for calculation of net profit are to be added back, and that income, non-operating income, which was added to the net profit, should be deducted. So this will, see, I'll tell you again, that is net profit plus non-operating expenses which were not related to your operations, but still you have deducted that. So that has to be added back. And non-operating income, which the income which was not related to your business operations, which was added to your net profit, has to be deducted. This total figure divided by the sales multiplied by 100. So you will get the operating profit ratio in percentage form. Next is operating ratio. Now what is this operating ratio? See, it is different from the operating profit ratio, by the way. Operating profit ratio was talking about the profit generated from your core operations. It was the profit generated from your core operations, that is operating profit ratio. Whereas when it is operating ratio, it is nothing but your cost of goods sold plus operating expenses upon sales multiplied by 100. COGS is cost of goods sold. That means your total cost involved in production, manufacturing your product. That is the cost of goods sold plus the operating expenses. Operating expenses as in the day-to-day operating expenses, regular expenses which are involved with the production activity. All these total expenses, the total of these expenses divided by the sales value multiplied by 100 gives you the operating ratio. Why did I say that? Again, remember this, that it is different from the operating profit ratio. Why is it different from the operating profit ratio? Because in operating profit ratio, we were calculating the profit to sales percentage. Here, we are talking about expenses to sales percentage. I hope I am clear. In case of operating profit ratio, we were calculating the operating profit to sales percentage, whereas here we are calculating the expenses to sales percentage. That means if we have to analyze which ratio, how and how it is to be analyzed, when it is operating profit ratio, it should be the higher the better. So if your operating profits are higher, it should be better for the organization. Whereas when it is operating ratio, now just imagine if this operating ratio is higher. If operating ratio is higher, it means that the cost and the expenses are higher as compared to your sales. So when your cost of goods sold and operating expenses are higher, that means your operating ratio is higher, but it also means that there is a very lesser margin for your operating profit. So in a simple way, operating profit ratio and operating ratios are opposite to each other. Operating profit, if it is higher, that's good for the organization, but if operating ratio is higher, that is not good for the organization as it reduces the profitability of the company. Next is return on capital employed. So here what is done, that how much returns are generated for the capital that has been employed in the organization. ROCE, the formula is EBIT. EBIT, we know it already. It is earning before interest and tax. It is earnings before interest and tax divided by the total capital. When we say capital employed, we are not looking at only equity capital or debt capital. It is the total capital invested in the organization. It includes your equity capital, preference capital, reserves and surplus, and long-term debt. However, only fictitious assets, which are fictitious, which are not real, which are not tangible, that has to be deducted from this figure. And everything is multiplied by 100, so we'll get the return on capital employed in percentage form. Similar to return on capital employed, we have another ratio called as ROE, return on equity. In the previous ratio, that is return on capital employed, we were concerned and we were looking for the returns generated over the total capital invested in the organization. But here, when we come to return on equity ratio, here we are concerned with the profit and the returns generated for the shareholders' capital, the equity capital. And when we say equity capital, what is done is, when we say return on equity, the formula is profit after tax and preference dividend. That means once we have come to profit after tax, even after that, the preference dividend has to be deducted. The preference dividend, because preference dividend is not an ownership of the equity shareholder. So that again has to be deducted from the profit after tax. Preference dividend is deducted, and whatever balance is left, that is divided by the equity capital. Equity capital includes equity capital plus reserves and surplus. Equity capital plus reserves and surplus together, it is also called as net worth. Always remember. So sometimes by chance, if you get a question regarding RONW, return on net worth, return on net worth and return on equity will not be different, because net worth is nothing but the owner's capital. Equity capital plus reserves and surplus. So I hope the formula is clear. Profit after tax and preference dividend divided by equity capital plus reserves and surplus, and everything multiplied by 100. So again, this would be. Similarly, we have return on total assets, that is the profit after tax, the net profit generated divided by total assets. That means by using the total assets, how much revenue is generated in percentage form. Yes. So how efficiently you are using the total assets to generate profit for your. Now moving towards turnover ratios. What are these turnover ratios? Fixed assets turnover ratio. First is FATR, fixed assets turnover ratio. Here what are we doing? Net sales upon fixed assets. Here what are we doing? We are doing net sales upon fixed assets. What does it mean is that by using these fixed assets, how much sales are being used, or in other way, that how many times these fixed assets are being used to generate sales. That means when we call it as turnover ratio, we are using this term, that how many times your fixed assets have been turned over to generate the net sales. Yes, so the formula is net sales upon fixed assets. Remember, turnover ratios are in absolute value forms. They are into times. 3 times, 5 times, 7 times, 1 time, 2 times, half time, 2.5 times, that way. Turnover ratios are not in percentage form, whereas profitability ratios were in percentage form. Remember that. Total assets turnover, like fixed asset turnover ratio, here you have total asset turnover. So it is net sales upon total assets. How many times your total assets are being converted to generate? Working capital turnover ratio, it is net sales upon working capital. Working capital is, we know it already, we have done we have done a separate unit. It's current assets minus current liabilities. Yes, current assets minus current liabilities is your working capital. When you divide net sales by working capital, it tells you that how many times your working capital is being rotated in a year to generate the net sales. How many times is your working capital rotated or turned over to generate the net sales? That's your working capital turnover. You also have debtors turnover ratio. Now what is this debtors turnover ratio? Debtors turnover ratio are the people to whom you have sold on credit basis. The formula is credit sales upon average accounts receivable. That means as compared to the accounts receivable is a current asset. You already know that. So how many times your accounts receivable figures are turned over to generate the credit sales. In simple terms, how your credit policy is working so as to generate more of credit sales. How many times as that of your credit account receivables, your credit sales are being generated. So the figure is credit sales upon average accounts receivables. When we say average accounts receivables, why is it average? Oh, average is nothing but the opening balance of debtors plus closing balance of debtors upon 2. Always remember, when you are calculating average debtors, it is nothing but the opening balance at the beginning of the year plus closing balance, that is at the end of the year, divided by 2. That is the average accounts receivable, and that figure is used to calculate the debtors turnover ratio. Yes. Based on the debtors turnover ratio, we can calculate the average collection period. It simply means that what is the average duration for collection of money from each of the debtors. Now, of course, this is an average figure. We cannot calculate for each and every person or for each and every debtor. So, this is an average figure. So, the formula is 360 days in a year. It is assumed that there are 360 days in a year divided by the debtors turnover ratio. Whatever turnover ratio we will get in the previous slide, what we have seen, if you divide 360 days by it, you will get the average collection period in days. Remember, average collection period comes in number of days. Then you have creditors turnover ratio. Creditors turnover ratio, like whatever purchases you have done on credit, whatever materials you have purchased from your vendors on credit, that's your credit purchase. So credit purchase upon average accounts payable. So credit purchase is okay. The amount of materials purchased on credit period from your vendors is credit purchases for the whole year divided by average accounts payable. Again, the average would be opening balance of creditors plus closing balance of creditors divided by 2. That will give you average accounts payable. So it will tell you that in how many years, what is the benefit or how efficiently you are able to get the benefit of your average accounts payable so that to get the purchases on credit. Inventory turnover ratio, also called as stock turnover ratio. What does it tells you is the formula is cost of goods sold upon average inventory. Now this is not done on sales because in sales your profit is also added. Whereas when we are talking about inventory, we are mainly concerned with the cost of production. And that is why the formula is cost of goods sold upon average inventory. What is cost of goods sold in simple terms? Your sales figure minus your gross profit will give you cost of goods sold. That is sales figures, net sales minus gross profit will give you cost of goods sold. So it is the total cost. Ultimately, it is the total manufacturing cost for a company. So when we say cost of goods sold upon average inventory, inventory value again, when it is average inventory, the formula would again be opening balance of inventory plus closing balance of inventory upon 2. Opening plus closing balance divided by 2 of the inventory for the whole year. So it is the total cost of goods sold divided by average inventory will give you the stock turnover ratio, also called as inventory turnover ratio. Yes, we also have something called as capital turnover ratio or sales to capital employed. That means how many times your capital is being used to generate the net sales. Yes, so the formula is simple, net sales upon capital employed. Yes, next type of ratios are leverage ratios, debt to equity ratios. Leverage ratios are mainly concerned with the capital. We have already talked about trading on equity or leverage of equity. Leveraging it, so it mainly relates to the capital structure part of the organization, the funding part, the financing part of the company. So the ratio is related to the financing of the company will be into the leverage ratios. The first type is debt to equity ratio. So it is long-term debt upon shareholders fund. How many times of your owner's funds are your borrowed funds? So long-term debt, all types of debt. It will include your loans, all your term loans, it will include your debentures, it will also include any other type of long-term borrowing by the company. So all the long-term debts divided by the shareholders fund. And when we say shareholders funds, here it is not just equity, okay, it is all shareholders. So it will include your equity capital, preference capital, reserves and surplus, profit and loss account balance, everything, and everything would be added over here. So that's your shareholders fund. That's debt to equity ratio. proprietary ratio. Proprietary ratio is nothing but the proprietor's funds to total assets. It simply means how much of your owner's funds, proprietor as in owner's fund, that is equity plus reserves and surplus plus P&L account balance. How much of your proprietor's funds are useful to create the assets of the company? In other terms, you can say that out of the total assets, how many assets come from owner's funds? Whatever assets of the company exist, out of these assets, how many assets are actually bought or acquired by using the owner's funds? That's your proprietary ratio. Net worth to debt, it is like the reverse of debt to equity ratio. That was debt to equity ratio, you can call this as equity to debt ratio. So it is net worth. Net worth is nothing but the owner's funds upon debt ratio. It is just the reverse of debt to equity ratio. Next is price earning ratio. The PE ratio, price earning ratio, is nothing but the market price per equity share upon earning per share. Market price of the share upon equity share, earning per share. So what does it mean? That as compared to the earning, that is the company's earning for each share, what is the value that the shareholders are perceiving in the market? Say for example, the market price per share is say 30 rupees and the EPS is 5 rupees. So what does it mean? That even though the EPS is only 5 rupees, earning per share is only 5 rupees, but people are perceiving the price 6 times as that of the EPS. So it is 30 upon 5 would be 6. So the people are perceiving 6 times more value in the market. Again, it will be higher the better. That is what is PE ratio. PE ratio. Yes, mainly investors look at these ratios. EP, your earning per share ratio or price earning ratio. Ratio to this, that's called as DPS, dividend per share. Dividend per share is when we were looking at earning per share, we have divided the earning available for equity shareholders by number of equity shares. But the earning available for equity shareholders does not guarantee that the whole money would be distributed in the form of dividend to all the equity shareholders. Out of that, based on the dividend policy, the company declares a specific proportion of the total earnings to be distributed in the form of dividend. So whatever amount has been declared as for dividend distribution, that amount divided by number of equity shares will give you dividend per share. Will give you dividend per share. This ratio is a very straightforward. It tells you that how much returns is a company directly giving per share every year. Okay. Now you have dividend payout ratio, dividend per share, and now you have dividend payout ratio. So dividend payout ratio is nothing but the dividend per share upon earnings per share. So it is DPS upon EPS. Dividend per share, we have seen that how much dividend is available and how much earnings are available. What does the ratio means? It tells you about the tendency, the nature of the company or the promoters, that how much money was available per share, how much earnings were made behind each share by the company, and out of those total earnings, how much is being distributed in the form of dividend. So if the dividend payout ratio is higher, it becomes lucrative for the investors, and if this ratio is lower, it becomes lesser lucrative for the investors, because even though the company is earning a lot, still it is not paying the dividend in the same proportion to the equity shareholders. That's your dividend payout. Yes. This is another ratio called as dividend yield ratio. What does it mean? Dividend per share upon market price per share. It means that if as an investor, if you are buying a share at the market price, that means you are investing at this rate, how much returns are you getting for your investment as compared to your investment in each share, how much returns you are actually getting from the company. So if this ratio is higher, the company is lucrative for investors and people long to invest in this company. But if this ratio is lower, people are reluctant about investing in such shares for a longer period of time because the dividend do not seem to be so lucrative. That's your dividend yield ratio. Yes, we are almost coming to the last part of this. It is market value to book value ratio. Market value to book value ratio. What does it mean? The market value is the market value per share, or you can say market price per share divided by the book value per share. Yes, book value per share is the total money generated by equity shares divided by number of shares. That will give you the book value. And market price is the current market price called a CMP, or the currently traded, the price at which the share is currently traded in the market. So you divide the market value per share by book value per share. And what do you try to assess from this is, as compared to the book value, is the company overvalued or undervalued in the market? Is the company really worth? See, this is the true worth. When it is book value, it becomes the true worth. But out of this, what is the market pursuing as the value of the company? Yes, that can be assessed from this market value to book value. So from investors' point of view, this ratio is very important. If the market is if the company is overvalued, people don't tend to buy such shares, rather they tend to sell off those shares. If the company is undervalued, that means market value is lesser than the book value, people try and invest in such shares so that in the long run, the value of the market value of the company will surely rise. Yes. So these are some of the important ratios that we have to be thorough with from examination point of view and from understanding point of view as well. I want you all to really be thorough with all the ratios. Write down these ratios in your notebook, learn them by heart, and let us study how to use them. Yes, thank you.